Good evening, everybody. Kamar Ellis here. Tonight's topic is how to pick a financial advisor. All right, so happy Wednesday, everybody. You know, this is Wealthy Wednesdays. Every Wednesday, we get together, talk about a topic, and I answer your money questions. So if you have any money questions as you get ready to get going, come on in, put them in the chat. Make sure you put a Q in front of it so I can know it's a question. By the time everything's all done, I can answer those questions. But as we get started, make sure everybody comes in. Let everybody know that you're here. Say your welcomes. You know, you got to do a black style, right? You got to come in and say your hellos. Make sure you give everybody your greetings. All right. But come on in. Tell me where you're yelling from and let me know if you have a financial question. All right. So this is the Finance Rebel Show. Every Wednesday we do Wealthy Wednesdays. I answer your questions about taxes, stock, business, investments. If it's a money question, it's on the table and we talk about it. Okay. So I wanted to talk about a couple things today as we get ready to get going. We saw some stuff. Feds did their thing, as always. I wanted them to see a little bit more, and I'll tell you about it in a second. I wanted them to do a little bit more, but I'm happy. They raised rates. The Feds raised rates by 25 basis points, but I wanted to pull up an article just to go over it real quick. I think y'all know by now that I feel like interest rates should have been raised a long time ago, way before we had this fight for inflation or fight against inflation. And to me, it was a no-brainer. We had interest rates way too low for too long, right? I mean, interest rates have been damn near 0% for the last 13, 14, 15 years. So I think we're long overdue for that. But I wanted to show you Fed Chairman Powell talking about this as we get ready to go. But I wanted to, again, talk about Fairmont Powell. Fairmont. I'm tongue twisted tonight. Let me get a drink of water real quick. Okay. Federal Reserve Chairman Jerome Powell. All right. We'll be talking about this in a second. I wanted to show a clip of it. Because again, I still don't think everybody understands the role and how interest rates are used to stimulate the economy, to slow down the economy. And it's a really crucial point. So again, I wanted to talk about that real quick. As we pull this up, give me 1 second. All right, so there's Jerome Powell, Federal Reserve Chairman.
In the past 2 weeks, serious difficulties at a small number of banks have emerged. History has shown that isolated banking problems, if left unaddressed, can undermine confidence in healthy banks and threaten the ability of the banking system as a whole to play its vital role in supporting the savings and credit needs of households and businesses. That is why, in response to these events, the Federal Reserve, working with the Treasury Department and the FDIC, took decisive actions to protect the U.S. economy and to strengthen public confidence in our banking system. Our banking system is sound and resilient with strong capital and liquidity.
Now, if you listen to what he just said, right, everybody's really spooked by what happened to Silicon Valley Bank. Then we saw Credit Suisse do this major fire sale. So there's a lot going on in these financial markets. You got to be paying attention to it. I almost didn't want to talk about this today, but somebody got to talk about it, right? So let's get back to it.
We will continue to closely monitor conditions in the banking system and are prepared to use all of our tools as needed to keep it safe and sound. In addition, we are committed to learning the lessons from this episode and to work to prevent events like this from happening again. At today's meeting, the committee raised the target range for the federal funds rate by a 1/4 percentage point, bringing the target range to 4 3/4 to 5%. And we are continuing the process of significantly reducing our securities holdings.
So what a lot of people don't realize is that when he says they raise rates to 4.75, almost 5%, right? That's the target rate for interest rates. That's the lowest barrier. And then you have what's also called the prime rate, where a lot of banks key off that rate to determine their loan amounts. So everything kind of goes back to the banks, or excuse me, to the interest rates from the Fed. So we're going to see prime rates increase. We're going to see interest rates increase on credit cards, and maybe even some more interest rate increase on mortgages. So it's going to be interesting as we get going along.
Since our previous FOMC meeting, economic indicators have generally come in stronger than expected, demonstrating greater momentum in economic activity and inflation. We believe, however, that events in the banking system over the past 2 weeks are likely to result in tighter credit conditions for households and businesses, which would in turn affect economic outcomes. It is too soon to determine the extent of these effects, and therefore too soon to tell how monetary policy should respond. As a result, we no longer state
tighter effects, meaning that money flowing from banks and other lending institutions is not going to be so free willy. It's been free for a while. It's been very abundant and plentiful for a while. And this happens in every market cycle, right? So we're going through a tightening market cycle right now. So we're seeing that banks got spooked. They're like, oh no, we got to pull back. I can't loan to you for this new real estate investment project that's very speculative. Or I can't necessarily give you money for this business because I don't know if I'm going to get it back or not, right? And so you're seeing these runs on a bank putting fear, or I don't want to call it fear, putting reality back into bankers, into the overall financial system. Because again, we've been running with lack of discipline for a while. Like, so I don't know how many market cycles y'all have seen over the years. I've seen at least, let's see, 2000, 2001, 6, 7, 8, 9. So that's 3. And we had a few in between. So at least 4, right? So this is what happens quite often, right? People get enthusiastic. They go out and start businesses. They spend money. And then something happens. Somebody gets a little crazy. Somebody gets a little loose, and they do something crazy. You can go back to LT, long-term capital management. We can go back to the banking crisis or the real estate crisis, right? There's always these weird, exogenous, exotic events that kind of snap people up around a little bit financially and say, hey, it's time to tighten up. And that's what we're seeing right now. So let's get back to this.
That we anticipate that ongoing rate increases will be appropriate to quell inflation.
How seriously was a pause considered for this meeting?
So we did consider that in the days running up to the meeting, and you see the decision that we made, which I'll say a couple things about. First, it was supported by a very strong consensus, and I'll be happy to explain why. And really, it is that the intermeeting data on inflation and the labor market came in stronger than expected, and really before the recent events, we were clearly on track to continue with ongoing rate hikes. In fact, as of a couple of weeks ago, it looked like we'd need to raise rates over the course of the year more than we'd expected at the time of the SCP in December, the time of the December meeting. We are committed to restoring price stability and all of.
So you have a lot of people talking about the Fed is basically ruining the economy because they keep raising rates. Why? Because they want it to be sweet. They want to be able to get credit easily so they can get access to capital easily, money easily. But nobody's thinking about the bad side of this. I've talked about this a while, how a zero interest rate from the Fed is helping to widen the wealth gap, the black-white wealth gap, right? Because when you do this, the people who have money and means, when you have a zero interest rate, by the way, people with money and means, usually non-black folks, are able to borrow capital, put it to work, get returns at a much, much lower risk rate. Those without means are just kind of locked out largely because for a lot of reasons, right? But I think we all can agree that racism, systemic racism is still real and it still locks out a lot of people. Now, within these groups who have been targeted by racism, Black folks, people of color, there are some who have been able and been fortunate enough to break out, defy the odds, and do some really, really dope stuff. But that doesn't speak to the majority. It only speaks to a minority, a small group. So it still begs to argue, why aren't more able to do that? Is it just because everybody's just lazy? Or maybe these issues are really deeper than some of the people on media, some of the people in politics really, really, really want to speak to. It's amazing why they don't want to give reparations, but that's another conversation for another day. All right. But again, they're saying now they're going to have to tighten rates because, again, inflation is running rampant. They don't have a control. They move too slow to start tightening up in the beginning. And I've been saying that for over a year.
Well, the evidence says that the public has confidence that we will do so, that we'll bring inflation down to 2% over time. It is important that we sustain that confidence with our actions as well as our words.
So that was an interesting thing, right? I always love to pay attention to what's going on in the economy because all of this impacts us one way or another. You might not always see it directly in your face glaring, like higher gas rates or higher egg prices. Everybody was complaining about egg prices, but when it's time for you to go get a mortgage because you want to get a new home, you'll see the effects. When it's time for you to get a new credit card, you'll see the effects. When it's time to possibly get a loan for your business, you'll see higher interest rates. These are all effects from the Fed Reserve increasing interest rates. So make sure you keep that in mind. Make sure you keep that in mind. Keep an eye on the ball, y'all. Don't lose sight of that. So real quick, we got some people in the building. Still Rocks 33 is in the building. Happy Wednesday to you. Welcome, welcome, welcome. Oh, man. What a privilege. The Side Hustle Society blessed me with a $10 Cash App. Excuse me, not Cash App. Super sticker. Thank you, sir. Thank you, Elijah. Everybody go follow the Side Hustle Society over there. Got to give you the double tap on that. All right, so as everybody's coming and getting more on TV, where you been, brother? What's up to you? Big salute to you as well, sir. Thank you for joining us in. Thank you all for joining. Welcome, welcome, welcome. This is another edition of the Finance Rebel Show, and you know this is the Wealthy Wednesday edition. So if you have any questions, stocks, taxes, business, economics, go ahead and throw them in the chat, and I will be sure to answer those questions. All right. So again, Fed Reserve has increased interest rates by 25 basis points or 1/4%. They usually do it in a range. So the target range right now is 4.75% interest to 5%. So that is what the interest rate is right now. So just keep an eye out on that and know that sounds like we're going to have more. So everybody tighten your belt. The good thing about this though, right? Checking accounts aren't going to pay like 0.5 pennies on your checking rates. Your CD accounts are going up. Savings rates are going up in your savings accounts. So now you can start seeing some real gain from having your money in the bank. So keep that in mind. Keep that in mind. But as always, I still believe that cash is king. Cash is king. Cash is king. I know a lot of us don't believe that because they've been listening to many financial gurus. But why are these banks going out of business? They don't have enough cash. Run on a bank, people have been removing deposits, taking out deposits, withdrawing deposits. So know that you want to be making cash. You want to be able to keep cash. Now, why do you want to keep cash? You want to keep cash so when things get crazy like it is right now, you have assets to go buy things, right? You have assets to go do more. Whoa, where you been, man? What's up, Anthony? How you been? Thank you for the $50 super chat. Appreciate that. Are you still doing the book club? I'm thinking about it. I'm actually going to launch a support group for my new my new and established business owners, but I'll talk more about that a little bit later. Don Johnson is in the building. Everybody's reporting it right now. Appreciate y'all. Appreciate y'all. All right, so today's main topic, all right, how to pick a financial advisor. Things have been rocky. Markets have been turbulent. Everybody's like, what the hell is going on? More people have been looking for financial advisors. I had an interesting conversation the other day with a CPA friend of mine who asked me, Kamari, what in the world do financial advisors do? Now, she's sharp sister, does a lot of her own investing, but she referred a client to a CPA. No, excuse me. She referred one of her tax clients to a financial advisor, and she was a little miffed about what's been going on in terms of the management. So one of her questions was, do all financial advisors invest money? So there's a lot of myths. So from that question, I realized there's a lot of myths, a lot of gray area, a lot of nuance, a lot of non-understanding about what exactly financial advisors do. Now, you're probably asking, well, Kamari, you're a tax guy. What do you know about financial advisors? Well, guess what, ladies and gentlemen? I used to be a financial advisor. Series 6 license, Series 7 license, Series 65 license. So I could sell all the investments. I could give investment advice. I was what was called an investment advisor rep. So I was also a fiduciary. So we'll talk about that a little bit more as we get going, right? But from being a financial advisor, I then was able to go to the next level and become an investment analyst, especially analyzing ETFs, exchange traded funds, along with stocks, some bonds as well. And then I lost my job and I went back to taxes, kind of a roundabout way, right? Giving y'all a long story short, real short. So, I've had all those licenses. I've worked in just about every facet of personal finance and small business. So I feel like I'm pretty qualified to answer that question. Like, what exactly does a financial advisor do? And how do they get paid? So I want to go over a couple of things. I wrote a couple of notes, right? So there's some things I wanted to go over. All right. So I wanted to talk about in terms of financial advisors, right? How to pick one, right? What is a financial advisor? What do they do? Because a lot of people think they do something else. How do they get paid? And how to pick one. So I wanted to talk about all those as well. So TB just trying something that I wanted to talk about. Should I have 12 months emergency fund instead of 6 months? So TB, I'm going to start this and I'm going to come back to this towards the end of the presentation. I ain't forgot you though. I won't forget you. So again, how to pick a financial advisor is the main topic for the evening. Wanted to cover that because, I've been getting some questions about that. My CPA friend kind of brought it up to me. Then I had somebody else today ask me some questions about being a financial advisor, what it entails, what are you supposed to do, how to get into it, the whole nine. So I figured people are asking, and I'm seeing more people asking questions about where to find good advisors. So I figured today would be a good opportunity to talk about it. All right. So what is a financial advisor? It might not be what you think it is. A lot of people think a financial advisor is here to make you rich. That's the furthest thing from the truth. All right. A financial advisor is here to help you make better financial decisions, to help guide you in making those financial decisions. And there are different strategies, specialties, and focus areas of financial advising. And today in this conversation, I'm going to be talking about financial advising and financial planning, one and the same. Now, if you get really into financial nerddom as I do, one could actually separate the two because they have two different distinctions, but the mass public kind of sees them as the same thing. But they are not here to make you rich. They are here to help you see your blind spots. They are here to help you devise strategy. They are here to make sure that you're getting wise counsel and that they're able to bring strategies to the market. So a financial advisor isn't just about bringing you that hot stock. A financial advisor isn't about selling you a specific type of insurance. While you have people who will impersonate and imposter being financial advisors, financial planners, by saying, hey, you should buy this hot stock. By the way, I got a story for y'all. I need to tell y'all that. It's not just that. A financial advisor, a good one, is able to understand the whole financial field and help you devise a strategy and help you devise the things that you need to be concerned about in your whole financial world. Now, usually financial advisors will start with risk management, will be having an emergency fund, having enough insurance, whether it be disability insurance, life insurance, car insurance, homeowners insurance. There's a lot of people that don't understand those things. And also, like I said, sometimes financial advisors may understand all of these things, but are not the specialists in those things. So they understand how to be the quarterback of the whole financial picture. And they know how to pull a lawyer or an accountant or an insurance person or an investment person. And sometimes they handle a lot of things themselves, but they still know how to go out and say, you know what, we have to do what's best for the client. And I might not be the person who could just give you the best advice on the newest insurance policies or the newest stock or the newest ETF or the newest gobbledygook that's out there, because there's so many things that's out there and there's so many things that are changing in the landscape. All right. So wanted to talk about that. Now, I kind of talked about what a financial advisor does and what they do, or what a financial advisor is and what they do, right? Again, they help you mitigate risk for the things that you can't see. So if there's nothing else you take away from this, just remember that they help you mitigate risk. One risk may be you're working, you have a family, a spouse and a child, you have no life insurance. What's the risk there? I don't come home, I lose the race against the train track or against the bus. My family is without the income that I will provide. Wouldn't you say that's a major risk? I would say that's a major risk. All right. Quick reminder, folks, everything in this broadcast on the show is all for entertainment and educational purposes only. This is not investment advice. Remember, past performance is not an indicator of future results. It's only entertainment. So remember that, y'all. All right. So before you do anything, make sure you talk to a licensed professional, tax advisor, legal advisor, or investment advisor. I am just here for the entertainment and education portion, y'all. So again, an advisor is there to advise. They're not there to put themselves like you. They are not you. But a lot of times people can't discern and see what's real, what's not real. Understand that, hey, if I lose my job, the average time to find a new job takes about 9 months. So do I need 6 months of savings? Do I need 3 months? Industry standard is like 3 to 6 months. We just had COVID. COVID's still here. Right, but we were locked down for over a year. So how long, how much cash should we have? Well, it depends, right? And then you see a lot of these memes go around and say, cash is trash. And all I want to say to that is this. You big dummy, you big dummy, you big dummy. Because again, if you study history, because that's what a good advisor should be doing, they'll tell you there's great times where you should be accumulating cash. And then there's times where you should be dispersing cash. And if you don't understand that principle of having cash, or you want to spend everything that you get, you're never going to be in a great position to build wealth. So just keep that in mind. Keep that in mind. All right. So I personally like fiduciaries. Now, there's different types of advisors. They get paid in different ways. There's usually two main types. All right. So the fiduciaries tend to get paid in fees, advisory fees. Right now, the industry standard is they get paid off of what's called AUM, assets under management. Also, you do have financial planners who will create an actual strategy, will take the time and create a strategy and plan for you. And they'll detail everything out for you and give you this beautiful printout and then help you implement everything. Because if the advisor says, hey, I need you to get some life insurance. Okay, where do I get that from? You have some advisors who will sell it to you because they are licensed to do that. You have some advisors, let me back up. You have some advisors who will sell it to you because they're licensed to do that, and will get a commission off of that. And then you have some financial advisors who only get the fee for preparing your plan. And they don't want to get commissions off the sales of these products because it creates a conflict of interest. Because the conflict becomes, am I just working for the fee, or do I want the fee and the commission? And sometimes there is no right or wrong, because sometimes you'll have some advisors who create the plan. The client only wants them to implement all the stuff. And so they get a commission. Now that should be disclosed. Everybody should know that. The client should know that. Everybody that's involved should know that. It shouldn't be something that's guessed about. It should be out there, full transparency. And that's what being a fiduciary, or one of the main things about being a fiduciary, is about: full transparency. Okay, there's even, when it comes to investing, there's a thing called no front loading or front running, where if I get an investment before I give it to my client, I'm out of order. I could be fined for that. That's a finable offense. So there's some other standards for fiduciaries that typically are not enforced. And I'm saying this loosely because there have been some changes, and they are enforcing things more on what they call registered reps. Those are people who were like me before, who just had like a Series 7 and maybe a 63 or a 65. Not 65, just 63. And they just could sell stuff, but they were not necessarily able to give advice. All of this is changing. So, but for the most part, those who operate under fiduciary standards are the ones who are going to be more transparent than not. That doesn't mean the guy that's licensed to sell life insurance is not transparent. It just tends to happen, from my experience, from what I'm seeing, that they tend not to be as transparent, if that makes sense. So, those are some things you want to think about. And like I said before, you have fee-only planners or advisors, and then you have commissioned advisors, and then you have, again, hybrids, people who do both. Like I said, they want to help implement the products, to help facilitate the plan, and they also want to give you the plan as well. Now, I want to say this, and I really want to stress this, and I hope everybody gets this. All of these products float down around here, they really don't matter. What really matters is the strategy. What's the strategy you're going to use? You're seeing everybody talking about crypto, and how crypto is going to be the savior of wealth, Black wealth, all the above. But then nobody talks about how crypto has its own characteristics and acts. It's kind of its own asset class, right? And so your advisor should be able to come in and say, hey, you don't necessarily want to be 100% crypto. You make $1,000 a week. You spend $900 of it every week for bills, clothes, food, all the above. You can't afford to just put stuff in risky assets, where the client may be like, but I want that. That's about to be the new hot thing. It's going to be popping. The advisor is supposed to be the one to come back and say, wait a minute. Let's look at this. Let's look at the data. Let's look at the history and the data, how it works, how it functions. Is that good for you? Is it bad for you? How do you feel about it? And kind of put it all in context. So those are the things that should be done by an advisor. And it's really, really important. A lot of people don't realize just how important a good financial advisor is. All right. Now, going back to how do advisors get paid, right? So I talked about commissions. I talked about fees. The average fee for AUM ranges anywhere from about, let's say, 1% to 2% of assets under management. So if you manage $100,000 for an individual, you can expect to be paid $1,000 a year to $2,000 a year. It all depends. Now, there can be some other fees. Like I said, they could charge for fee planning and some other things. Those will be outside of the scope of that. But that's kind of the industry standard, just to give you a place to look and a benchmark to kind of gauge things from. All right. But again, you want to put that all into context. Now, I wanted to talk about, how does a person get paid? Excuse me, not get paid. How does a person pick a financial advisor? How does a person pick a financial advisor? So one of the things you have to understand is, again, are they a fiduciary or are they just a salesman? Now, sometimes y'all will see me on the show and I'm just in my bag and I'm just talking, and I will call a lot of people just pure salespeople, because I do have this love-hate relationship with the financial services industry, because I've seen a lot of people just sell products without any care about how this fits into a person's financial situation. I've seen a lot of people sell products without any care on how the tax implications are going to impact them. There's tax implications in everything. Every financial transaction is a tax implication. So that should tell you something right there, right? Taxes are all around us. Taxes start wars. So we need to pay more attention to tax, all right? But also, before I get into this a little bit deeper, remember, financial advisors a lot of times have specialties and they do different things and they're good at different things. So all the time, they don't always have a one-size-fit-all option. All right, so just keep that in mind. All right, so talk about fiduciaries. How to find a financial advisor. Number one, don't just pick the first person you meet. You can go through some typical channels, asking friends, asking referrals, asking other professionals who they work with, who they refer to, but it should be an interviewing process, all right? You should be able to get to know them, get to know their character, get to see what they do. And don't necessarily be in a rush to do this. I'll tell you this, from some of my high net worth individual clients that I've worked with over the years, some of the things that have been said to me several times by ones who are 7, 8 figures. They said, Kamari, I've asked around about you. I've done my due diligence about you. I see how you act. I see what people say about you. I watched you. Watch some of these folks. See how they handle. See how they've handled under pressure before. So again, it's really good to get referrals to see how, if they've been in their business for, let's say, 20 years, how did they handle things during 08 and 09 when the market was crazy? How did they handle that? Did they communicate with you? Did they not return your phone calls? How did they communicate? Get that. All right. Specialty. Next one, specialty. What's the advisor's specialty? Many people call me an advisor. You can say my specialty is tax. I'm cool with that. But I was also an institutional money manager for many times, so I can do investments and talk investments with the best of them. But my business is tax right now, so I would be fine with somebody saying my specialty in tax is tax. Guess what? There's specialties within tax. You have business strategists, you have real estate accountants. I mean, there's a plethora of them out there. So make sure whatever advisor you have, it works for your situation. Are you a highly compensated employee that's an executive and you get a lot of stock options? Well, if you do, you want to have somebody on your team or this advisor that understands stock options and how they affect you from a tax perspective, how they affect you from a retirement perspective, how they're going to affect you from a risk perspective, right? Because if you go back far enough to, like, let's say, an Enron, if anybody remember Enron, I might be showing my age. A lot of those folks had all their money concentrated in Enron stock, and then Enron would belly up. So hopefully a good advisor would have told their client that we want to diversify away from this. All right. So I wanted to talk to y'all real quick. I'm gonna interrupt this for a minute because I had a conversation the other day. I went with my client to purchase a new car, and the finance manager there was telling me how during the pandemic, he researched and figured out the stock market was a Ponzi scheme. Now keep that in mind. He said the stock market is a Ponzi scheme, and nobody should invest in 401ks. I'm sitting there turning red, and I'm kind of dark. It's hard for me to do that. I'm turning red because I'm like, this guy is very misinformed. And the one thing I wanted to say to him, do you know how many millionaires have been made from investing in 401ks? But I didn't get to that. I just said, listen, you're young. You should still keep investing in 401k and everything else. He says to me, well, my manager had all his money in his 401k. During this recent drop in the stock market, he lost $500,000. A half. I said, well, what was his advisor doing? He said he didn't have one. I said, aha. An advisor would have told you to do what? Let's look at your asset allocations, not just the hot stock. How much money do you have in stocks? How much money do you have in bonds? How much money do you have in international stocks? How much money do you have in crypto? Right? Because crypto is a thing now. How much money do you have in real estate? What's your personal home worth? They would have been talking to you about all these things. Oh, and guess what? I want to retire in 2 years. Oh, 2 years. So if anybody knows this, 5 years or less to retirement age is considered the retirement red zone. The retirement red zone. So by that time, when you hit that 5-year out mark, you pretty much want to start dialing back your exposure to risky things like stock, like crypto. You still want to have some, but you want to dial it back. Why? Why do you want to dial it back? You want to dial it back because at the point that's coming up when you go to retirement, the whole goal of retirement is to take the assets that you've invested and saved and turn it into a paycheck to replace the income that you get every day on your job or your business. So then you have to adjust and make different decisions when it comes to your money that's been invested. Just to say, hey, I have $500,000 and I lost, or excuse me, let's just say I got all this money in the market and I lost $500,000, to say the market's Ponzi or bad. I mean, I got a lot of things to say to that. Have you ever been in a car accident? Did you stop driving? Right? It's all about how you operate it, how you use it. It's not necessarily how the overall larger thing happens. It's about how you maneuver it. You have control over this. Now, if you take your hands off the wheel while you're going 50 miles an hour, 100 miles an hour, you crash, whose fault is that? You're going to say it's the car's fault, or is it your fault? So, you have to think about all those things. Now, remember, I'm coming to an end, y'all, but if y'all got any financial questions, go ahead and throw them in the chat. I will definitely get to them. All right, but like I was saying, make sure, one more thing, I almost forgot. So after the guy said that, I'm trying not to laugh. After this guy said, the stock market is a Ponzi scheme, the last thing he ended up with, he told me the stock ticker. I don't want to get a stock ticker because it's not an endorsement. It's a penny stock. It's a freaking penny stock. Now, if y'all been rocking me long enough, y'all know I feel penny stocks are the spoons of the devil. Why? Because a lot of people pump and dump those things, intentionally pump and dump. There was an article about 50 Cent doing it years ago. And I'm like, you talking about all this stuff being Ponzi schemes and you're promoting a penny stock. But with all that said, listen, be careful about who you take advice from. This is not advice, right? This is not investment advice. This is education and entertainment purpose. This is for education and entertainment purposes only.
It's only entertainment.
All right. So just remember, don't take advice from everybody, y'all. Especially not car salesmen or barbers. And I love them both. They're all great. But consider the source. And yes, within them, There are probably some good people who really know their stuff, but the probability of that is probably low. All right. So now I started this conversation off talking about my homegirl who's a CPA asked me, what does an FA do? They said, do all financial advisors do investments? I said, no, they don't. I said, actually, most financial advisors outsource it, right? Or they give it to some mutual fund company or some investment company. Again, it's all about the strategy. They're more about the strategy. Now, there are financial advisors who actually do the investing. I was one of them, right? But I also worked at the institutional side, so that's a little different as well. But they don't all do that. And so my CPA friend was really, really unpleased, very unhappy how her client's portfolio was. It was like, there's no rhyme or reason. They got all this tech stock. Apple here, Facebook there, Microsoft there. She couldn't tell what the strategy was. I asked her, do you know what her philosophy is or his philosophy is? The financial advisor, that is. Nobody ever thinks to think about that. My philosophy is that there's always opportunities in the market. We don't need to be using heavy leverage or any leverage at all. And that patience is our key. Also, time horizon dictates everything. So there's always opportunities in the market. Patience is key. Time horizon dictates everything. So if somebody tells me I only have a year before I need this money, I'm not recommending stock. Or if I am recommending stock, it's a very small percentage of your overall portfolio. Your overall portfolio construction or the mix of stocks, bonds, cash should be very, very risk averse. Should not be looking to swing for the fences or hit home runs or slam dunks. I'm looking to be safe because if you need it in a year, you can't afford to lose the money. And as we've recently seen, we've seen the markets just drop at the drop of a dime with no rhyme or reason, and people were caught with their pants down. It's not a good feeling, especially if you're in retirement or approaching retirement, because then you're like, oh shit, what am I going to do? Do I have to work longer? Do I have to go work in Walmart? No diss to the elders that work in Walmart as greeters. Actually, some of them are pretty cool. But you only want to have to do that because you want to do it versus having to do it. There's a difference. You want to be in control when you get to that point. All right, so make sure you understand what the person's philosophy is, especially when it comes to investing, but what their overall philosophy is when it comes to financial advising. They should have a philosophy. They should have a way that they think about it, see it, visualize it, implement it, and guide you through this. That's important. That's very important. All right. Then you have people, right? They get with it. Some advisors, strategy's wrong. We have some people, all they want to do is go after the hottest stock. All they want to focus on are super tech stock because they're trying to swing for the fences and they want to make money. But you might be, again, approaching retirement. I'm using that because this is one of the things that a lot of people face. They probably aren't a good fit for you. However, if you're young, you just got going working, they could be a good fit for a younger crowd. Or they may only be good to give a portion of your assets to. And I was talking the investment side now, right? Because again, financial advisors do more than just invest. But from an investment stake, they may only be good for 5 to 10% of your overall portfolio. You don't want to give them the whole thing. People do that. People have a lot of high net worth people have a lot of advisors. Now, for smaller clients, smaller individuals, they might not be able to do that because it's spreading too little, too thin. So, you have to work towards your level. You have to seek your own level. You have to make decisions and form strategies against your own level. For the record, I'm seeing people go around social media saying, if billionaires do it, why can't you? I think that's some of the dumbest shit ever. You know why? Because you're not a billionaire, number one. Number two, you don't understand the mindset of a billionaire Number three, the billionaire has money to lose. Most people that are being sold this advice, it's all they got. This is all that they have. They ain't got no backup plan. There is no plan B. This is all that they have. So no, they can't move like billionaires do. Sure, they can take cues from them. They can't do exactly what billionaires do. So if you're looking to model a billionaire, you want to figure out what they did to get to the billions. You don't want to try to emulate what they're doing while they're a billionaire and you're just a thousandaire. Mixed match. Strategies are out of alignment. Right? So just keep that in mind. All right. Other thing you should think about when picking an advisor, what are their credentials? What are their education? Did they go to school? Did they just test for this? I've seen advisors who were college PhDs, phenomenal. I've seen some advisors who all they did was high school, really, really good because they were students of the craft. All of them were all students of the craft. That's the thing that really distinguished them. But you want to understand the time and energy they put into it. Now, are they just working on the weekends, doing Primerica, just selling you some stuff? No, that's the Primerica, but it is what it is. Most of them are not what I would consider financial professionals. You want to understand that. Now, if you want to go to Primerica and just get some life insurance, start out, that's good too. But you need to understand what you're going to them for. Understand it. Don't just say, because, oh, I went to high school with them, or we've been friends forever. This is your hard-earned money. You got to respect the hard work that you put into it. And anybody that's going to compete for that money, to work with that money, they should respect it too. And the credentials that they've amassed shows a level of respect and admiration they have for the field and industry overall. So keep that in mind. Keep that in mind. All right. And I tend to like vetted advisors. They've seen so many different things. They're able to give context, understand the nuance a lot better. If y'all notice, you have been rocking with me for a minute. I love the words context and nuance and people not understanding them. So, it's really, really important to be able to have a good guide, because at the end of the day, the advisor is just a guide to help you miss out on those landmines, to help you get to your goal, not their goal, not your buddy's goal, not your homie's goal, not your mama's goal, not your daddy's goal, your goal. And if you have a spouse, y'all's goals, right? The couple's goals, the people you're walking with life together. Those are the people that are able to walk hand in hand and do that. It's not about everybody else. Again, I just said, the crappiest advice of me, doing what billionaires do. Well, what if you don't have the aptitude to be a billionaire? And what I mean by that is a lot of pressure. You don't think Bill Gates has a lot of pressure on him, even though he says he has a really simple life? Every time there's a major financial crisis, he gets a call. Did you deal with that? Then let's think about this. Most of my audience is Black, working middle class, right? Y'all know what happens when y'all get a couple dollars. Somebody's going to be knocking. Can I borrow this? Can I borrow that? Can you deal with this? There's a whole different mindset that has to go when you're looking to elevate. And again, you got to be able to seek your own level, not what everybody else does. So do your research. Because I'd say I get a lot of flack from this. I got flack from my financial advisor mentor about this, right? But what I say is financial education is more important than a financial advisor. Because the better financial education you have, the better of a client you'll be. Also, to get duped by some of these fraudsters. There's plenty of them. I cover them. There's a lot of posts covering them. Oh, wow. Here's the tee up, y'all. Pocket watching with JT. Super chat. Thank you, sir. JT covers them. He covers all the fraudsters. Just like his thing. He got it down pat. But what I will always say about JT, because people know me and JT are cool, he knows the shit. So he's pulling out the gem or the problems, what they have, and then he's teaching y'all how to do it. So salute to JT. Go follow JT's page. He done hit 70,000, so he don't need no more followers. He already at the top of the mountain. But salute to JT. But again, financial advisors can be really, really good and really, really important. You just have to know how to use them just like any other professional. You have to know what they're there for, what their value is, and use them properly. All right. So with that said, what questions do y'all have? Go ahead and throw them in the chat, and we're going to get into this. I know I had a couple before. I had a couple starred, so we're getting to this. I need to adjust my desk because my legs hurt. I'm getting a little old, y'all. So I need to sit down. So give me 1 second, and I'll get at these questions. All right. So TB had a question, right? So TB had a question. Should I have that 6 months, right? So I get in trouble for this. I personally think everybody should have a year's worth of income in their disposal in cash or cash equivalent. And I won't go too deep into that, but you should have some cash liquid for a couple reasons, for emergencies and for opportunities. What's the famous saying everybody kind of gets wrong, right? When there's blood on the street, it's time to buy. Well, if you ain't got no cash, you can't do that when there's blood on the street, right? And again, if there's an emergency, the roof falls off, the car breaks down, something happens, you want to be able to rectify that quickly. Quick story. My son's in business right now. He's got a mobile detail business. And I've been on him. I'm saying, listen, you got to put that thing in a shop regularly. Why? Because that's your workhorse. You got to make sure the workhorse has been taken care of. If any of y'all familiar with Westerns, again, I might be showing my age, but my grandparents would watch Westerns. My mama would watch Westerns. One of the things, if you notice, you can't ride a horse all night long and forever. Got to make sure the horse rests, get some food, get some water, right? Same thing with a vehicle. Get some gas, get lubed up, address certain things. Now he's like, but I ain't got time to do it, Pop. I said, well, you don't not have time to do it. Because if that goes down, then what you going to do? Right? So it's the same thing when you need stuff, when you need the money. So don't get into the habit of spending all of your money just because. Use this money as a tool for your prosperity, for your family's prosperity, and also for your community's prosperity, right? Because one of the best things we can do for the community is not be poor, in my opinion, right? Now we're in a position to give, help, mentor, in whatever way it may come. So I would say, personally, have 12 months of an emergency fund there. Now, here's a trick. A lot of people get scared by that because they might make $50,000 a year. I'm not saying go right today and drop $50,000 in the bank. Make it a goal. You got a tax refund? Know a lot of y'all get them. Take a portion of your tax refund and put it into your savings. Got a raise on your job? All right, well, don't increase your lifestyle every time you get a raise. Take some of that extra money and put it aside. I just paid off my car, my wife's car. The goal is to put that money into savings. Don't want a car no time soon. Salutes to that, by the way. Things are pain in the butt. I want to put it away. I'm not even really a car dude like that. Why go get another car note? Keep that money. So that's my opinion. Again, anybody has any other financial questions, comments, concerns, go ahead and throw them in the chat and I'll get to them. It can be stocks, taxes, economics, business, whatever you got, go ahead and throw it in there. All right, TP, give me the thumbs up. All right, back lady, good evening, good evening. John James asks, is the 60-40 portfolio still a good place in this market? Well, 60-40 has been getting poo-pooed for a lot of people. I don't know why, because what happened was, again, the Fed had zero interest rates, so we saw the stock market go for a nice long run, and people thought it was going to go up forever. If you've been rocking with me for a while, you know you've heard me say this for a long time, that there was going to come a day where things go back to normal. We're kind of at that day. Not always, but kind of. So 60-40 can be good. But for who is the question? Who is it good for? You need to understand what your risk tolerance is, right? And not just the questionnaires that you get from the financial advisors. Like, how do you feel when you see the market jump up and down? Does it give you a problem sleeping at night? I have some friends who have a problem sleeping at night when the stock market is all over the place because they got money in retirement, or they'll say, like, one of my friends said, man, I just lost $250,000 in the market. I said, did you sell? He said, no. I said, well, you didn't lose. You only lose when you sell. The market has come back time and time again. Start studying the history of the market. Don't just get into watching the dummy news where it says the Dow Jones closed up 500 points a day, or the Dow Jones closed down 400 points a day. That's all financial porn. All right. Warren Buffett says he doesn't even pay attention to what goes on daily because it's just a blip. But Warren, if you look at Warren, Mr. Buffett, his strategy is to hold forever. Doesn't plan to sell. What is your strategy? How long do you plan to hold? Do you need this money in retirement? Do you need this money for college? Do you need this money for a business? Whatever your goal is. When do you need it? If you can figure out when you need it, you can figure out what your asset allocation should be. And by the way, asset allocation is more important than just stock picks. So am I more of a trader or more of an investor? I'm definitely more of an investor. I have done day trading when I was a professional investor, right? I was trading somebody else's money. I've traded my own money too. Lost a bunch of money, lost a lot of money. Won some money, made some money too, right? But I think everybody should start as an investor. Understand the market, learn the market, like really learn the market. Learn what a stock is. Is it a piece of business? Is it just a stock? Is it a piece of business? Does it just go up and down? Do profits of that business matter to it? Does the management of that business matter to it at all? Does the area in which the business operates, like, is it selling water? Is it selling t-shirts? Is it selling tires? What's the likelihood of that business surviving? All of those things matter. Galvanized Financial CV, thank you for joining us. I don't think I've ever seen you here today, so welcome, welcome, welcome. Suitability and knowing your client are key. Yes, knowing your client is definitely key because you can't build a strategy if you don't know your client. Client got kids? Got grandkids? What stage of life are they in? Are they a blue-collar worker, white-collar worker? Do they have a lot of money invested? What do they think about the market? What do they think about family? What are their goals for the family? What are their goals for themselves? All of those things are super duper important. So thank you for saying that. Mr. Wayne Sully, one of my tax brothers here. I like the show. You should be on radio, my man. I've been on radio. This is where it all started. Radio's where it started. Fell in love with radio. 2010, 2011, somewhere around there. Had a chance to do a talk show in Philly, Black Talk Radio in Philly. And then I discovered social media and the power of social media and the educational value of social media. If anybody ever pays attention, I'm not really the hypey-hype dude. I want to give you the facts. I want to give it to you what it is. And guess what? I don't know everything either. People think, Kamari, how do you do this so long? Well, I'm old. I've been around for a long time, but I don't know everything. But thank you for that, Wayne. Appreciate that, sir. A 1,000 air. What's that? What's that, Elijah? A 1,000 air. Is that? Yeah, what is that? All right, JT says preach again. Thank you, JT, for the 1999 super chat. I need to get the super chat sound. All right, Wayne says, my issue with traditional IRAs is the tax implications at retirement. The tax hit might be huge. I have a client who at retirement are at a high effective tax rate. I believe a person should have the match only. I like IULs. So Wayne, I've seen you talk about that before, but I'm gonna push back on you a little bit. What if it's a high income earner and that's their only tax deductions? And IULs are cool too, right? Because I had some high earner clients as well, and I talked to them about the benefits of whole life and IULs and how it can be a tax savings, right? You can use it for a lot of good things, right? You get the benefit of the death benefit plus the cash value. So there's a lot of things that can be done with it. But again, what if they don't have any tax deductions? They need the 401k, right? So you know this, Wayne. I know you know this. I can tell. Every situation is different. Every client's going to be different. So, I don't believe in cookie cutter advice at all. I believe strategy is more important than products. That's proven out 1,000% of the time. So you can have a product that you like. However, that product is not a blanket endorsement for everything that this person is going to go into. For example, you brought up IULs. So I'm going to use not IULs, but infinity banking, right? I see people talk about infinity banking all the time. Infinity banking typically is good for people who have high income. I have seen CNAs, and this was at the time they're making like $9 an hour, maybe $10 an hour, being sold these life insurance policies because infinity banking is all about life insurance for the most part. And they don't have good emergency funds. Terrible strategy, terrible. But some insurance people who love to throw out these catchy cliche things sell a boatload of them. Good salespeople, just not highly ethical. What are they going to do when they have an emergency? One of them did, that I can remember clearly. Car broke down. Went to go access the cash. Well, they can get it, but it was still in surrender period, which means for people that are watching, surrender period with permanent life insurance policies, let's say you put $1 in day one, you're only getting back 80 cents, right? Then you got to wait a year. Then maybe you'll get 90 cents. And then the year after, you'll get 95 cents. But they didn't do any real planning for them. They just sold them a freaking product, man. And I'm just like, that's bad. That's bad. So, but Wayne, I appreciate you, brother. All right, back lady, you mentioned that high net worth individuals may have multiple advisors. Is it realistic for a high net worth individual to try to simplify her finances? What could that look like? Absolutely, they can simplify their investments or their finances. Some of my more wealthy people are looking to simplify. Now, I do have a lot of clients that are in real estate, so it's kind of hard for them because their investments are in real estate. So that gets a little complicated, but yeah, simplifying. What does it look like? Let's start with investments. One of the things that I used to see when I was kind of young in the industry is they would have all these mutual funds that all track the S&P 500. Not even thinking about what they do, how they react when the market goes up, how they react when the market goes down. Didn't think about any of that. But when I started going through it, I said, there's a lot of overlap. This S&P 500 is heavy in Home Depot stock or heavy in Exxon. And you got it covering the same things. You might have had 20, 30 of those things. I found that having a portfolio of maybe 7, 8, 9, 10, 12 ETFs, exchange traded funds, I am biased towards ETFs. I will admit that. But I think I can make a good argument for them too. That'll typically do the thing. People with a whole bunch of stocks, seeing people with hundreds of stocks in their portfolio. For what? Do you look at, again, the correlation, the pattern of movement with these stocks? Do they go up when the market goes down? Do these stocks move together? You probably don't need 100 stocks. I know for certain you don't need 100 stocks. Some people just like them. They want to get a little bit of this and a little bit of that. You know, some Amazon, some Nike, some Tesla. You know, by the way, none of this is investment advice.
It's only entertainment.
Let me say that again.
It's only entertainment.
I don't want nobody getting confused. All right. So, yeah, you could simplify things. Also, years ago, I would see people with multiple life insurance policies. 5,000 here. These are some of the old ones. 5,000 here, 13,000 here. Sometimes it might make sense to roll all, because you can roll life insurance policies in. You can roll them all together and get a bigger policy. And a lot of times you'll get more insurance for the buck, the more coverage you get, the higher death benefit. So it tends to go down. Man, I'm rusty. For every 100,000, I believe it is, that you get, it tends to go down in price. So you got to look at the economies of scale that you can get when you have the opportunity of combining all those things. So that can be helpful. Listen, if y'all don't know this, but if y'all like this, y'all here with me all the time, do me a favor, like, comment, and share this out. Like, comment, and share this out so more people can find the Finance Rebel Show. We are here every Wednesday at 8:30. 8:30 is the tax season time because I've been busy. Where are we at? Thunder's in the building. What's up, Thunder? All right, Thunder says, do you know that Charles Schwab brought TD Ameritrade? Yep, I know. And what do I think about it? Big bank, take another bank. I don't really have any thoughts about it. Schwab is good. TD's good. They'll be fine. Like Schwab, I do like some of Schwab stuff for retirement. I like some of TD stuff for just straight trading, but it's fine. It's not an endorsement for either one.
It's only entertainment.
Remember that. All right. Wayne says the deduction is cap. All right, Wayne, what's deduction? I know I told you was talking about 401ks. So yeah, they get the 20,000 somewhat. And if they have a Roth 401k, ooh boy. Ooh boy. That thing's crazy. But for some of our business owners, they can get busy with a Roth 401k, individual IRA. They can do a lot of things. But I'm not sure which cap you're talking about. All right, Thunder says, question, is it true that in July the U.S. will roll out a digital dollar? And if so, how will it benefit? How can we benefit from it? Well, if it's a digital dollar, they've been talking about that. I'm not sure the timing of it. There's not a whole lot of cash, like physical cash money circulating right now anyway. We saw a shortage of it over the pandemic, especially coins. So I could see the Fed and the U.S. getting involved in digital dollars. Again, they've been talking about it already. How will it benefit us? I don't see how it hurts us. How can it benefit? I think things will just be the same, right? You got your $1, $2 in the bank. You can take that same $1, $2. It's all mostly digital anyway, right? You can still offer and exchange it elsewhere. So I don't really see how it could be different. I could be wrong, right? Something else may happen. It might push crypto to a certain level or another level. But for right now, I don't really see anything. Back Lady says, thank you for that answer. My pleasure. I am at your service. So thank you for being here. All right. So what time is it? Ooh. We approaching the 10 o'clock hour, y'all. So I appreciate y'all. Any other questions before I get out of here? I ain't had my vittles yet. So y'all know I had to get some vittles, get some sleep, get back up to getting at these taxes. There was one thing I wanted to talk to y'all about tonight, but I think I'll save it for another day. We went kind of long tonight. So again, any other questions you have? All right, here we go. Wayne, there are income limits for a tax deductible contribution. Yeah, absolutely. But, like I said, if they have nothing, I know a lot of guys who have nothing. Thunder says if you have a 401k, Roth cap is $22,500. A Roth with a 22K cap, why not go for it? So there's more to the Roth than the 22 cap, especially if we look at the catch-up provision. Also, there is, with any 401k, there's employee employee match. No. Let me back up. There's employee contribution and there is employer match, right? One thing I said, and Wayne will agree to this, right? And I'm sure if JT's still here, he'll agree to it. If you can get a 401k and get the match, please take the match. You are brain dead if you don't enroll your 401k who has a match. And everybody doesn't enroll in those and they have matches. You're missing out on free money. Free money. So yes, do that. At the bare minimum, do the match. So, but the other part is, right, you can get the match and you can put money in. And when you work for some of these bigger companies or your own personal company, it's way more than $22,000. Way more. And the things you can do to it, like everybody's talking about G-Wagons this and 6,000 pounds that, like it's the new freaking tax code. Yeah, it's cool. It's not a cheat code. It's kind of stupid, right? You want to put all this money into a depreciating asset. If you were really doing something, you would put your money into a retirement plan. If you're a business owner, you can borrow from your retirement plan depending on how it's set up, right? You can't borrow from a G-Wagon. You buy it, it's gone. And then I only want to go into all the other tax implications when you got people that want to trade it in, when they're talking about the 179 tax deduction, when trade it in, you might be creating a whole other tax event. None of these gurus are telling you that. But folks love to follow them. They love to listen to them because they sell you something sexy. But here's the real deal. Most of these social media gurus are just trying to sell you some shit. And they make it all salacious. And most of them, again, are telling you stuff that only 1% of the population can do. G-Wagon, $80,000, $90,000, $100,000 car. The average salary in America is like $54,000. So do you think it's good to spend 2 times the average salary on your business? Now, yeah, if you got it like that, if your business is profitable, if you got plenty of savings in the account, if your retirement's funded, if you're maxing out all your tax deductions, most people ain't doing that. So they tell you this stuff. They try to give you the steak and the sizzle on top of a garbage can. But again, blanket advice is trash advice, in my opinion. Blanket advice is trash advice because everybody's situation, facts, and circumstances are different. Let me give myself a orange for that. So think about that. Think about that, right? You know, everybody's situation is different. Again, the real cheat code, forget the G-Wagons, forget the 6,000 pounds. Start a retirement account. Start a pension fund. See how much money you can put into that sucker. Take loans from it. People, again, make things sexy because they want to sell you something. They don't want you to be empowered. They don't want you to see you rise. They just want to sell you some shit. And it's bullshit at that. But, you know, I digress. I digress. All right, I saw there was a couple. Right, yep, there are income limits. So listen, there are income limits for everything. The tax code is black and white, and there's a lot of color in the middle. I don't like to say gray. So you kind of got to know to play with it. And I'm not trying to insinuate doing anything illegal. It's not what I'm trying to do. What I'm saying is we got to be good students of the game and do what's good for our level. So for the wealthy individuals, it won't work. For an employer-sponsored plan, it will work. Now, we can debate the impact. That's a different conversation. Different conversation. No taxes with a Roth, right? No taxes with a Roth if you do it right. Money needs to be in there for at least 5 years. Number one. Number two, Roths grow. It's after tax money. So you pay tax on it when you got it, right? But it grows tax-free. You can pull it out tax-free as well. So yes. Yeah, Wayne Sully says they are knowing the shiny objects to the people to get likes. It's marketing. Yeah, It's unethical marketing, though, in my opinion. Some people disagree. When people say take a vacation on the IRS, I feel that's disingenuous. The IRS is not giving you back money. Yeah, you might get a tax break, but that ain't their money. The government's in business to get your money. And yes, they do all these other services, roads and armed forces and everything else, right? For some of my other folks. But again, that's not the game. The government is a house. If anybody's been to the casino, they're not just giving you back money to go travel on jet set. But right. So Nicole Marie says, I have a pension. My employer matches 14%, but you can't take a loan on that money. Well, Nicole, I'm sorry, I didn't get proper context, right? So y'all know I always talk about that. So I got to be accountable to what I love and what I hold dear. So I was talking about if you are the business owner. So again, just to give it context, all of these social media so-called gurus who are,
You big dummy.
all right, I ain't gonna do too much of that, but they are telling business owners to do the Section 179 bonus depreciation for big write-offs on their cars, right? So they can write it all off in the first year. That's one of the quote-unquote plays. Wish that word would go away too. I was saying that none of them have talked about creating a pension plan. You can put away 6 figures in a pension plan, a real pension plan, not 401k pension plan. Nobody's talked about that. And in that pension plan, there are, and some of the 401ks, right? Because you got defined benefit and defined contribution. I'm starting to nerd out on y'all, giving y'all too many technicals. I'm sorry. But within pension plans, there are, in some retirement funds, there are opportunities to give out loans to yourself, to do whatever you want. Again, you got to follow the law. You got to follow tax guidelines, right? But that's the real cheat code. Ain't none of these jerkies talking about that. It's not sexy enough. Costs money. Got to do some things. But they rather tell you to go buy a depreciating asset, to go get a new Cadillac or get a new G-Wagon or get a new whatever the 6,000 pound flavor is, because it sounds good. I wonder how many car dealerships sponsor some of these folks, but I digress. I'm not going to go into that. I'm not going to go into that. But even on your 401k, you can take a loan also up to a certain point. So for all my anti-401k people, right, for those who are just working a job and you are just building from the bottom, from the mud, trying to go from 0 to 100, there's nothing wrong with putting your money in the 401k plan. Because I've seen plenty of people who put money into a 401k plan, and guess what? They left and they started their own job. And what did they do? They took the 401k, and there's some other techniques into this to get around it, but to keep it simple, they took the 401k and they used it to fund their business. All the while not paying tax on it. They might have paid some at the end, but if they listen to somebody like me or folks like Wayne or JT or others, they figured out ways to get around that legally, ethically, right? So, you know, there's flexibility around the tax code. Remember this. So I'm gonna end this, right? Real quick. Yep, agree with you. Yep. Just took money out my 401k this year. All right, my man Dick, how you doing, brother? Welcome, by the way. No. So no apologies needed, Nicole. Not at all. All love, baby. So okay, I get it. My apologies. Nope. I didn't give the proper context. Because I was speaking quickly and freely, and Wayne's a CPA. I believe you're a CPA, Wayne, I believe, right? So he kind of jogged me into this whole tax realm, and I started nerding out. So my apologies. So no apologies needed. Thank you for being here. But I've seen a lot of people take money that was in their 401k and do a lot of great things with it after they leave their job, separation of service. I've also seen people who are on their job, because it all depends on what the plan document says. They have what's called in-service withdrawals. They would take the money out of their 401k plan, move it and do whatever the hell they wanted to do with it. Most of them use it for some business or real estate ventures, right? A lot of times it's usually age requirement with that, but depending on how the plan document is written will determine how much you can do. Usually not a whole lot of leverage for basic employee, not calling you basic in a bad way, but for employees that work somewhere. But if you are a business owner, there's a lot of power in having a retirement plan, having a very, very flexible plan document, and using your retirement funds to do some other things with you. So, all right, there it is. Wayne is a CPA and a life insurance producer. All right, there we go, Wayne. So, again, personal finance is personal, y'all. Make sure that everything that you do. All right, Midnight Green's here. I love acknowledging all y'all because I appreciate all you here. Thank you for joining us tonight, Midnight Green. Make sure everything that you do, there's a reason for it. There's a rationale for it. Not because some stupid idiot social media guru, impersonator salesperson, slimy salesperson is trying to sell you something. Do it because it makes good money sense. Do it because it'll be good for you personally. Do it for you because it'll be good for the family. Do it for you because it's good for the overall legacy. Nothing else. Nothing else. And don't do dumb things that can possibly get you locked up. All right, because that's what some of them are encouraging. And I don't believe in any of that, especially Black folks. We need to stay as far away from the criminal justice system as possible. All right. So, and that's from experience. Not mine, some of my families, some of my friends. So, again, I thank you all for joining me here during the Finance Rebel Show's Wealthy Wednesday edition. I'm tired, y'all. I need my vittles. So, if you have not subscribed to the channel, if you're new here, please subscribe. If you haven't done so, please like the channel. And I will see you all next time. Y'all be great.